Well, the U.S. Federal Reserve has kept interest rates unchanged for a fifth straight meeting, but an unusually divided vote has exposed growing pressure within the central bank to raise rates amid renewed price pressures and elevated inflation. Our three officials broke ranks in the decision, voting instead for a quarter-point rate hike. They were Dallas Fed President Lori Logan, Cleveland Fed President Beth Hammack, and Minneapolis Fed President Neil Kashkari. This is the first time since 2016 that three officials dissented in the same direction over a policy change. But Fed Chair Kevin Warsh pushed back against the idea that keeping rates unchanged reflected inaction, saying that the Fed remains committed to bringing inflation down.
Not one of my FOMC colleagues is under any illusion. We have begun a new chapter, and we understand that the 5+ years of inflation above target cannot be cured in 9 weeks or by a single month of modest price decreases. This Fed will not waver. Our credibility rests on performing our duties and delivering on our responsibilities.
But the Fed's policy decision and Mr. Warsh's assurances did little to ease market concerns. The U.S. central bank could face a tougher battle against renewed inflation pressures linked to the Iran war. The reaction visible in the world's largest bond market, where U.S. 30-year Treasury yields rose more than 10 basis points, hitting its highest level since 2007. And the move reflecting expectations that interest rates could remain elevated for longer, keeping pressure on long-term U.S. borrowing costs. Well, Wall Street's major indices all closed lower in reaction to the Fed's decision on rates. Dow dropping by more than 1,100 points for its worst day since April 2025 and worrying bond market signals. The S&P 500 and NASDAQ both dropped about 1.5% each. And for more, we're joined by Gareth Berry, FX and rate strategist at Macquarie Group. Gareth, thanks for your time today. So looking at what transpired with the Fed, right? Rates unchanged as expected, but what was a bit surprising was the three dissenting voices, dissenting in the same direction, of course. How significant is this, and does it mean that a September rate hike is now becoming the base case for markets?
So the dissents are hugely significant in our view, and it's a sign that some members of the FOMC are becoming increasingly impatient about the lack of action. So when Warsh took over his first meeting in June, he said all the right things, made all the right noises, and was very clear that the Fed is committed to hitting its inflation target. But of course, words are not enough. Actions speak louder than words, and we got no action last night. And three dissenters felt the need to put their views on the record, break ranks, and call for an immediate rate hike. Now, my suspicion, though, is that they weren't just keen to hike yesterday, or overnight rather. They probably also got an inkling that there's no rate hike in the immediate future either. So they were unwilling to wait even longer than that. So they felt the need to break ranks as they did overnight. So that's a sign, I think, that we may have to wait a little bit longer for Kevin Warsh to cross the line into rate hike territory.
Well, that's interesting. So they said that they got an inkling that there's no hike in the medium term at least. What kind of signals do you think they're getting that's causing them to feel that way?
We'll learn more in the next week or two when those three dissenters have an opportunity to put their views out there in public. Kevin Warsh was asked that question overnight, and he said, look, he'll let them speak for themselves. So we'll discover that shortly. But I think it's intriguing that the dot plot still exists, and Kevin Warsh encouraged his colleagues each to plant a dot on the page back in June when we saw the last edition of that dot plot, but that he himself chose not to participate in that exercise.
Yeah.
So perhaps those three dissenters are getting concerned that Kevin Warsh's views are not aligned with theirs, and it's time to take a stand.
Okay. I think some analysts are saying that, the war, the oil prices, is a supply shock bout of inflation, and that's not exactly something that the Fed can fix with rate hikes. What are your thoughts on that?
Yeah, so there is a credible argument that there's not much the Fed can do in this kind of a situation. The trouble, though, is that it's been 5 years now with inflation running higher than target, and eventually enough is enough. Something has to be done. And to be fair as well, even though the Fed can't control the supply dynamics, they can certainly use a rate hike to influence demand, and that can bring supply and demand back into balance. So that argument, though credible on the surface, it's starting to lose some of that credibility as time passes.
Okay, and we're seeing some pretty swift reaction there. Steepening of the yield curve rather significantly. Shorter-term yields were falling, but the longer-term yields are rising quite significantly. The 30-year one, in fact, crossing 5.2%. What is a message that the bond market is sending to the Fed? And at the same time, what is it telling you about, investors' expectations when it comes to inflation and growth?
So it's a concerning signal. I think the market is saying that they're not entirely convinced that Kevin Warsh will be willing to back up his impressive rhetoric with action, and that it might actually take a mutiny or a rebellion amongst the rest of the FOMC to finally force him over the line. Now, to get that, we would need 7 dissenters to come out to force the issue. That's not going to happen immediately. And the bond market is starting to allow for the possibility that we might have to wait longer to get that first hike. Now, it had been priced in completely by the September meeting. That's no longer the case. The market now thinks we might have to wait until October for that to arrive. Personally, we think at Macquarie that it will take until December for that first hike to come through.
Okay. Just to follow up on, what you said about how we're talking about dissenting voices and Kevin Warsh maybe not being aligned with what he said, or not being very transparent. What does it mean for markets, of course, when the Fed is not seem to be as aligned?
Well, the lack of transparency can be perfectly justified in many situations. So a central banker will never really want to tie their hands if they can avoid it. So you can certainly make an argument for what he's trying to do. But it is concerning that he has readily acknowledged that inflation has been running so high for far too long, and yet doesn't seem to be able to take the necessary steps to deal with that. He was asked repeatedly, why wait? Why not get a move on? And I didn't hear any credible answers to those questions.
All right, so it's a waiting game, and we'll of course wait to hear more from the 3 dissenters next week. Gareth, thank you so much for joining us this morning. Gareth Berry there, he is FX and rate strategist at Macquarie Group.